In this presentation, we will take a look at itemized deductions related to casualty and theft losses. For more accounting information and accounting courses, visit our website at accountinginstruction.info. As we talk about itemized deductions, remember that we will only be taking the itemized deductions if the sum of all itemized deductions is greater than the standard deduction. The standard deduction, depending on marital status, things like single, married, filing, joint, currently $12,000, $24,000 respectively. The itemized deductions, the sum of all of them, would need to be over these amounts before we get a benefit from them at all. Casualty and theft losses. Casualty and theft losses. Under the new Tax and Cuts Job Act, a personal casualty is deductible only if attributable to federally declared disaster area designated by the president. In the past, this wasn't the case. The casualty and theft losses was much more broad. Now we have a much more narrow definition of the casualty and theft losses, only for the federally declared disaster areas. A casualty is generally defined as identifiable event that has a nature that is sudden, unexpected, or unusual. And to claim the deduction, the taxpayer must be the owner of the damaged property. The amount of the casualty lost will generally be the lesser of the fair market value immediately before the casualty reduced by the fair market value immediately after. In other words, if we're trying to determine what the actual loss was, we've got to say, okay, what was it worth before whatever happened? If there's a hurricane or something, what happened before the property? What was the value of it? And then we got to say, okay, it's still worth something afterwards. We can at least scrap it probably. And the difference between those two fair market values is the estimates that we would have to work with in order to come up with some number that would be the amount of the casualty or theft lost, or the amount of the adjusted basis for determining the loss from the sale or other disposition of the property involved. Remember that the casualty and theft losses must be attributable to a federal declared disaster area that is designated by the president. That's going to be one of the new changes. When calculating the amount of the casualty and theft, we have to reduce it by $100. That's just part of the code. It's been part of the code for some time now. Hasn't been increased with regard to inflation differences, and it hasn't been removed. So it's just one of those numbers that might not be a big impact on the tax calculation anymore, but it's still there. And we also have that loss must be in excess of 10% of the AGI, which is a pretty large threshold. So it's got to be greater than the 10% of the adjusted gross income. We're going to report the casualty and theft losses on the form 4684, and then at some point pull it over to the form, the Schedule A, which will be the form for the itemized deductions. For more accounting information and accounting courses, visit our website at accountinginstruction.info.